Welcome to the Financial Advisor Success Podcast, where you go behind the scenes with financial planner, speaker, and consultant Michael Kitces to hear stories of how leading financial advisors navigated the inevitable challenges that arise on the path to success, and get insight from leading industry consultants about how to break through to the next level in your advisory business. And now here's your host, Michael Kitces.
Welcome, everyone. Welcome to the 435th episode of the Financial Advisor Success Podcast. My guest on today's podcast is Gideon Drucker. Gideon is the CEO of Drucker Wealth, a hybrid advisory firm based in New York City that oversees approximately $1 billion in assets under management for 800 client households. What's unique about Gideon, though, is how he initiated a wealth builder offering serving high-income next-generation clients within a firm that historically worked primarily with retirees, that in just 5 years has added 275 high-value client households and has become the primary growth driver for Drucker Wealth overall. In this episode, we talk in depth about how Gideon shaped his firm's staffing to have a higher ratio of advisors to operations staff to serve clients on the wealth builder side, given the often extensive planning needs of mid-career professionals compared to the firm's retired clients whose plans are often relatively stable and just need more regular portfolio withdrawals. How Gideon ensured that his firm's wealth builder clients would be profitable by instituting a $5,000 minimum fee for new clients, while recognizing the fast pace that many of these clients are adding to their assets means they will likely generate significantly higher fees from assets under management over time. And how Gideon linked the announcement of a more gradual fee minimum increase for current clients to the value that the firm was providing them now, finding that clients who are already taking full advantage of the firm's services were the most likely to stay with the firm's new higher fees. We also talk about how Gideon's early years in the industry cold calling prospective clients inspired him to pursue a content-based approach to marketing that would be more sustainable in the long term, both for the business and his own well-being. How Gideon produced a blog and then newsletter and then book targeting his ideal target clientele of high-income working-age professionals to build an audience and awareness of the firm. And how Gideon conducts regular webinars with many attendees sourced from consumers of his written content that provide education on both finance-related topics and his firm's planning process, and typically result in 10 to 15 introductory calls with his firm after each event. And be certain to listen to the end, where Gideon shares how the growth of his firm's wealth builder division in terms of clients and services offered led existing clients to make introductions that produced 50 introductory meetings last year, despite him not even actively soliciting referrals. The importance Gideon puts on making the best possible hires for new positions and how he approached the challenge of letting go employees who aren't a good fit for the firm. And how Gideon has thrived in the transition from being a primarily client-facing advisor to taking on leadership and business management roles, seeking to turn over more of the day-to-day client work to his advisor team. And so with that introduction, I hope you enjoy this episode of the Financial Advisor Success Podcast with Gideon Drucker. Welcome, Gideon Drucker, to the Financial Advisor Success Podcast.
Thank you so much for having me. And I'd be mad at myself later if I didn't say this at the outset. I've listened to every episode of this podcast, and honestly, it's done more to shape my career than anything or anyone outside of my dad. So to be here right now is just kind of a special full circle moment. And I'm excited to dive in.
Well, I really appreciate it, and I'm excited to talk to you today. And I get into what I guess is one of my favorite subjects around the industry, which is this whole phenomenon of how we serve, quote unquote, the next generation of clients. The industry, I feel like, has this, almost fixation on what's now been dubbed the generational transfer of wealth, like however many tens of trillions of dollars are supposed to move hands over the next decade or two from mostly baby boomers to their children and grandchildren, for which the sort of standard industry solution is, well, then I guess we need to build relationships with the next generation of our clients' families. Like we have to build relationships with the children and grandchildren so that when pop dies, like we can still work with the people who inherit the money. And the fascinating thing to me, like I see so many firms talking about it and remarkably few where it's actually working in any material way. Like maybe if you're in the like ultra high net worth family office, multifamily office area where
Right. You're doing generational planning.
yeah, you are legitimately like running family meetings about how's everybody going to handle their $15 million inheritance kind of thing. But for the rest of us, I mean, the truth is most of us are pretty retiree focused, sort of by definition. If our clients are so old, they're regularly passing away, and we're having a concern
Right.
about generational transfers of wealth at death, and just their children and grandchildren seem to figure out pretty quickly that we're not really built for them. Like I don't really want to work with Pop's advisor. I want to work with someone for me, because when we focus on retirees, just we really know retiree issues. We don't necessarily know the issues, the financial planning issues that are front and center for clients in their like 20s, 30s, and 40s. And if we were that good at it, frankly, that would just probably be one of our core clientele in the first place. We wouldn't be so retiree focused. We'd have like a segment of the business serving next generation
Right.
clients with a business model and service model that fits them. And then you wouldn't even need the grandchildren and children of your clients, because you just have an offering for quote unquote young people. And I'm excited for the conversation today, because my understanding is that that's effectively what you built in your firm, is an offering for working with younger clients in a firm that predominantly historically worked with older clients and more retirees, and not just as this is a way to get like the grandchildren of our clients, but more no, we really want to generate like $1 million of revenue from serving next generation clients. And I'm just excited to talk like how that actually came about and what you built to make that happen.
Yeah, absolutely. I mean, yeah, as I'm listening, like I'm thinking about, I was thinking, wow, yeah, we didn't really have that as a game plan, or, like I didn't have this vision 5-6 years ago of anything that was going to come over these last 5-6 years of, building a new entire division or having more advisors or different service models. And I definitely wasn't thinking at all about working with the kids and grandkids. It was really just a natural evolution of, all right, who am I going to work with? Who do I enjoy working with? Taking it one client at a time, one prospective client at a time, until it kind of developed organically. And then you get to a certain point where there's momentum and, wow, I think I'm building something that can actually stand on its own. I'm enjoying this and I can kind of see where it's going. And that's when you start to plan ahead of, what you want to build out, how you want it to all come together. But at the start, yeah, there really wasn't a vision. There wasn't, I'd like to say there's a vision now, but there wasn't then. And really no part of it, even if it would be a good story at this point, no part of it was thinking I was going to be working with the kids and grandkids of my dad's clients, although that's what ended up happening. It was just, hey, who do I want to work with? Who do I think I'd be successful with? And letting it kind of happen from there.
So I want to get deeper into this in a moment, of just like the divisions of the business and what's been built. But I think first, as a starting point, just give us a overall picture of just the advisory firm as a whole as it exists today, so we understand the context of the business that we're going to be talking about.
Yeah, absolutely. So Drucker Wealth, we're an independent now RIA. We left our broker-dealer about 13 months ago as of recording. We're a fully virtual team. We have team members, clients throughout the country. And we have 2 client divisions at Drucker Wealth, each with their own service teams. So the team is kind of segmented into one of those 2 divisions. We have our retirement and income division. That is, clients that are 60 plus, traditional retirement planning. And, when I say we have 2 divisions, like prior to 5-6 years ago, that was the firm. There was no other division. So, there was no need to call it that. It was just, that's who we've been working with for 20, 30 plus years. And then we have our wealth builder division. This is what I created about 5-6 years ago for mid-career, high-income earning families, usually people in their late 30s and 40s, usually with kids, usually living in high-cost of area cities, really focused on full-life financial planning. Altogether, between those 2 divisions, we work with about 800 client families. We oversee approximately $1 billion of client assets, with $750 million of that being advisory AUM, and the remaining $250 million or so in annuities that's held at our friendly broker dealer. From a teaming standpoint, we have 13 people, full-time people on the team. That's made up of 5 lead advisors that obviously manage and run client relationships, 2 second chair or support advisors that help those advisors run those relationships, 3 operation managers, 1 estate planning specialist who is actually starting a week from now as of this recording, and then we have 2 people that operate more at a firm and leadership level. Bridget, who's our head of people and really serves as Chief of Business Development, and Nacy, who's our Director of Operations and also our Chief Compliance Officer. And obviously, I can get a little bit more into the teaming structure, but 13 people overall and about 800 families that we're working with on an ongoing basis.
And can I ask, what is revenue for the firm overall?
Yeah, so in 2024, we did a little over 6.2 million of revenue. 4.6 of that came from advisory fees. We did another 350,000 in upfront financial planning fees. That number is a little bit lower just because we transitioned the firm in February of last year. So the first 6 months were really transition focused more than anything else. My dad did another little over $1 million in annuity revenue, and then a small remainder from life insurance and disability. But that's really like less than 1% of the revenue at this point.
Okay.
And I'll make a quick note just for anyone doing the math at home, as quite frankly, I would be if I were listening in. We added a good deal of assets under management in 2024, a little over 125 million. And most of that was in the back half of the year. So we just quite frankly haven't, that AUM isn't part of the fees, obviously, for the majority of the year. So if our, AUM looks a little bit off compared to the, AUM fees, that's why it's just most of that money that new money hasn't been paid out yet. So we're expecting, in 2025, obviously market dependent, which, who knows when this comes out, but we're looking at, closer to 5 or 5.5, just, based on our kind of growth rate over the last few years.
5 to 5.5 million in advisory fees.
Right. Like closer to 5.5 of AUM advisory fees, just based on, money we added in second half of 2024 and already, the start of 2025.
Okay. All right, so that's really helpful. So now take us one step further. You said the company's kind of structurally in two divisions at this point. There's retirement and income for we'll call it the older clients, and wealth builder division for the younger clients. So how does the revenue split between those? How does the client count split between those? How does the team split between those? I'm trying to envision how divisionally split they are, and do you actually keep metrics by division, as it were?
Yeah, so we try to, just for our own understanding of what's going on in the business, not necessarily because we need to know those numbers. We understand most of the growth at this point. And by growth, I really mean client, number of new clients, team members we're, consistently hiring for is coming on the wealth builder side, even if just because, when we're working with retirees that have more money, quite frankly, obviously they're at it, if they have a new 401k roll, there's more money coming in. So they're still growing from just an asset standpoint, even if they're not taking on so many new clients at this point. But yeah, just to give some context of what the breakdown looks like. So the Wealth Builder division has about 275 families ongoing that we work with.
Okay.
So of the 800, about 275 families. And we, on the Wealth Builder side, manage 170 million of the assets under advisement. Okay. And that's all pure assets under management. We're on track to add another 75 million of assets under management on the Wealth Builder side this year. And then on the Wealth Builder side as well, we did last year about 350,000 of upfront financial planning fees and about 50,000 or so of insurance, mostly term and disability revenue. So obviously, the retirement income division has been around 30, 40 years, and they've been doing really well for a long time. So it still makes up, I would say 70% of the total revenue. Although, and I'd say the Wealth Builder is over time, 3 years ago, that was 90-10. 4 years ago, 5 years ago, that was 95-5. So it's slowly changing the dynamics over time as we're kind of building that runway to get to that point that the retirement and income division is already at.
Well, yeah, I'm struck. I mean, when you've got a retiree base that's north of 500 million to 750 million of, I'll just call it traditional retirees, adding 30% of revenue growth, working with younger clients in a wealth builder style division, that's a lot of growth change in a couple of years. I mean, that's literally a lot of revenue to add to say we grew. I mean, I'm just napkin mathing. That's more than $1 million of revenue that got grown on the wealth builder side in the past couple of years.
Yeah, that's fair. And to be fair, we've hired a few new advisors to support that growth, and just because we've done a lot of marketing, so we kind of know the flow of new clients that we have. And I'm sure we'll get into that. So we've been hiring for the Wealth Builder division. It's grown pretty organically, which has been a great thing. And we're trying to I'm fortunate in a lot of ways, in this business, growing up with a dad as a mentor. He's done a great job my whole life, and to have somebody like that has my back at all times, and that is my best friend, my role model. All of it is just how many people are lucky enough to have that. But I'm also lucky because I had the runway to build this thing right, to do it the way that made the most sense for our team, our clients, right? There was never any pressure of you need to sell this insurance policy or you need to do that rollover. It was just, hey, do a good job for your clients. Like, speak to a lot of people, right? Activity is the key to productivity. Something I've heard my whole life. That's definitely a BD aphorism. But he allowed me to find my own way of being an advisor, of how I wanted to market, how I wanted to grow, the type of clients I wanted to work with. Like, looking back, I realized how fortunate I am. So we've done pretty well over the last few years. But I also realized, like, most young advisors don't have that opportunity, that time to figure things out the right way and get to that point. So yes, there's been growth, but I really need to give a lot of that credit to my dad and our team that's allowed us to build this thing the way that made the most sense.
So you said that this is like staffed, like each division has their own service teams. So can you explain a little bit more what the staff of the team structure is for each side?
Yeah, absolutely. So on the retirement and income division, my dad, Lance, and Kathleen, we call her Kitty, are the two lead advisors for all client relationships. And they've been working together for over 15 years. Most of the client relationships even extend, longer than that. And quite frankly, they just kind of found their rhythm organically with their clients, in terms of how the clients want to engage with us. So there's a lot less like official, this is Lance's client, this is Kitty's. It just, Kitty runs a lot of client relationships. My dad, Lance, and so I don't say my dad, I call him Lance, when we're talking to anybody, Lance runs a lot of client relationships, some meetings they're on together, and some clients, they're very different personalities. It's like they have a great partnership, and but they're just very different. And some clients really gravitate towards my dad. I would say a lot more. He can be intense. He's a lot, type A New Yorker. Some are like, we like that Lance is, behind the scenes doing everything, but we'd really like to work with Kitty. She's more comforting. She's listening, and so they've really found their rhythm organically. Like I've said, in terms of who runs the client relationships, they now have a full-time second chair support advisor, Drew, who's a certified financial planner, but really, is more helping them get ready for meetings, sending follow-up. She can meet with clients, kind of operationally things have to happen, but really making it so that Lance and Kitty, the majority of their days are spent just sitting in front of clients, calling clients, really being the front-facing advisor. And then we have two excellent people in operations on the retirement and income side, Eric and Giselle, and they're helping clients open accounts, handling transfers, withdrawals. A lot of their clients have RMDs, so they're handling that all throughout the year, and they're both really hands-on. Like I think part of what my dad's done a great job of is giving everybody on the team an ability to grow, to find their voice. So, they speak to clients, obviously just on the operational side, not providing advice, but just, hey, if something needs to happen, they're comfortable calling the client. Hey, we need to move this. Remember, we were doing that. Just let us know how we can help. So they handle the operations side. And then Nacy, our director of operations, kind of oversees that, making sure everything's going smoothly operationally on the retirement and income side. So that's those six people really run the retirement and income side on a more day-to-day basis.
Okay. So then now tell me about Wealth Builders side.
Yeah, so on the Wealth Builder side, we have three lead advisors, what we call us, myself, Autumn, and Sarah. And we, by lead advisors, I really mean running client relationships. They're setting up their client meetings, providing advice. They're responsible for managing, taking care of the client. The firm really handles the marketing, the business development, lead generation, all of that. So they can, the individual advisors can spend most of their day in front of clients and then doing the planning work that's actually required to get in front of clients. And then in my role as a lead advisor, I have a second chair advisor, Karina. She oversees and really supports all of my client relationships. She's on every meeting with me. Clients are really, reaching out half the time. They'll email her, they'll email both of us. They know, anything that's not just, the pure advice part of it, she's going to respond and, make sure that everything gets done. And she actually started as an intern with us 6 years ago. Was just so incredible that slowly by slowly she's kind of become kind of my right hand and building this thing out. And so she's a support second chair advisors. second chair advisor. And then our newest hire, Tyler, is our operations manager. So he handles for the three of our, three lead advisor client relationships, all the account opening, transfers, rollovers, planning agreements. He's been fantastic. That was just, that's been a huge help over the last 3-6 months. And then Bridget, who's our head of people and really running the business development and marketing side of things with me. She kind of oversees, she's organizationally, running the whole team, but I would say spends a lot of time with the wealth builder side of things, just because so much of the growth, so much of the new ideas and new services we're offering are originating on the wealth builder side, that a lot of her time is spent with us figuring out how this is all going to happen. She's kind of the implementer on the wealth builder side, if just to use the EOS parlance.
So I'm struck in hearing this, that just the whole staffing structure feels quite different between the two sides. That there's two advisors, Lance and Kitty, for close to 500 clients on the retired side. There's 3 advisors for quote unquote only 300 clients on the wealth builder side. Lance and Kitty have 2 or 3 operation staff supporting them. Wealth Builders actually has 1. So there's you've got a higher ratio of advisors to serve the clients on Wealth Builders, but a lower ratio of operations to support the advisors on the Wealth Builders. Am I following that properly?
Yeah, no, that's a great point, and obviously something, this has been an intentional evolution, so something we think about. So a few points just to kind of bring that home. On the retirement income side, I would say the number of clients is a little, I don't say misleading, because that's how many clients, but a good deal of them are, I would say legacy clients. They're older, they're receiving their RMDs, their dividend income, their annuity income, and there's not so much ongoing planning that they're looking for. Like, if we reached out being like, hey, we're going to do this Roth conversion, we're going to talk about tax loss harvesting, they'd be like, Lance, Kitty, I have enough money, right? I'm good. I can live my life the way I want. I can take care of my family. I have money for the kids, and I have insurance and the right estate planning. So they do have a lot of clients that I would say we're still meeting with them, of course, throughout the year, but it's less hands-on changes to the plan that they're making just because of the stage of life they're at. And it's a lot more making sure operationally the money gets to them when they need it. The RMDs are coming out. We're changing their income strategy, right? As markets change, the amount of annuity income versus dividend and stock income. So that's why, Lance, Kitty, and Drew, all 3, so it's really 3 advisors, even if Drew is more in a supporting capacity. But that's why there's more operational support there, because I would say for a good 100, if not more of those retirement and income clients, it's more just making sure they're getting their income, and that they're, I would say more on the legacy distribution side of things rather than active week-to-week planning side. And quite frankly, the exact opposite is true on the wealth builder side.
I was saying, so that's why it gets reflected in staffing the way that it is, right? When there's more just, I need my money out of my account, I have to get my RMD processed. There's more sort of support operational processes. You end out with a higher ratio of operation support staff to advisors on the retirement side. On the wealth builder side, there's less investment dollar management things happening and money moving around. There's just a lot more planning things happening. And so wealth builders end out with more advisors and fewer operations on a relative basis.
Exactly. And just it's based on the stage of life of where the wealth builder clients are at. So if you're 43 years old, dual income household, you're making $500,000 a year, you have 3 kids. Well, we're going to be talking about education planning. We're talking about life insurance. We're talking about estate planning. We're talking about cash flow and your bonus coming each February and the RSUs that come quarterly. And you're thinking about buying a vacation home, and you're thinking about buying a larger primary home or moving to be closer to family. And now you want help with your older family. So there's a lot more planning work. So that's why the advisor count. Operationally, it's a lot smoother as well. Most of on the wealth builder side, we're using Altruist as our custodian, and between our wealth builder clients just being a little bit more, I don't want to say intuitive, although I guess I just did, but just, digitally, everything's a lot smoother. And then combining that with a, kind of forward looking digital custodian, it makes the operational that, Tyler can really handle, everything, because it's just a lot smoother on that side of things. And I'll point out, that's kind of answering from the client, right? Like, how do we deliver the best value to our clients in the retirement and income side, making sure that, the operational support is there to support Lance, Kitty, and Drew. And on the wealth builder side, it's really, over leveraging the financial advisors, because that's what creates the most value for clients. If I change the conversation, to more of a business side of things, right? Because you can say, well, you have 3 advisors, but a lot less revenue on the wealth builder side. I would say, we're skating to where the puck is going, or we're trying to, of, hey, we know how many new wealth builder clients we're taking on, over 75 new clients that we've done financial plans for each of the last, 3 out of the last 4 years. We know how much new assets under management. So we're building the advisory team. We're building the advisory team understanding where we're going to be at the end of 2025 and 2026. Even at the moment, we understand that we're 3 advisors for the amount of, we're kind of building it out, understanding the growth trajectory over the next 2 to 3 years, based on what it's been, the last 2 to 3 years, and the fact that it hasn't yet slowed down.
So you said part of this was, I'm struck on the custodian side now, that this is the younger, more digitally native clients. You picked the the digitally forward custodian with Altruist. Does that mean the retirement and income side does not use Altruist and uses a different custodian?
Yeah, we use Fidelity on the retirement and income side, and it's not 100% of people in one, but by and large, yeah, retirement and income is at Fidelity, Wealth Builder is at Altruist, and again, all of this, we launched our RIA 13 months ago, so both custodians are obviously new, and this all started last year.
So then I guess just bring me back for a moment. So why different divisions? Why so distinctly stated in different divisions? Not even, I'll say just air quotes, not just in terms of how you're marketing it, although I suspect we're going to come back to that in a moment, but literally how it's staffed internally.
Yeah, so I would say it happened organically. I'm probably making it sound a little bit more official than it really is, just for the point of explaining, how the differences. It really started as a marketing. Who are we trying to reach out to, right? You always talk about niche marketing. We want to tell our prospective clients, hey, here's who we specialize in working with. Here's, our wealth builder team works pretty much exclusively clients in their 30s, 40s, sometimes early 50s, but mid-career professionals at a certain income range, and so it allows us to find the right people and then do a great job for them. From a staffing standpoint, it really just happened organically. We started, most of the wealth builder side of the team was only came on board, was only hired in the last 4 to 5 years, whereas most of the retirement and income side has been with Drucker Wealth for for a lot long. Not everybody, but the Kitty has been with it 15 years, Nacy 10, 12 years, Giselle 7+. So that the staffing was a little bit more about, going to where, who needs more help, where resources need to be allocated, and letting that happen organically. So at this point, it looks like, we have these 2 neat divisions from a staffing standpoint, but it was more about, all right, who are we taking on as new clients? Where's revenue coming from? And then, really where do people on the team want to be? On the wealth builder side, we hired our first non-me advisor in 2021, purely because we had so many new clients that I couldn't handle the inflow at the time, that we said, hey, I think it makes sense to have a new advisor to work with some of these clients that are reaching out. And then we did the same thing again in end of 2022, beginning of 2023, when our next advisor, Sarah, joined. So it really did just happen organically as business evolved.
Interesting to hear that it shaped up this way, as opposed to, we had a grand division. We had a grand division of 2 different divisions with 2 different staffing infrastructures. But I guess I am struck with how different they shaped up to be, right? In just a simplest sense, a 3-to-1 advisor to support ratio versus a 1-to-1 advisor support ratio. I mean, just those are really different. And I get it. It's because different clients, different needs. It very much makes sense to me in how it's staffed. But if you came in with, well, we're used to, this is how many clients an advisor can support on the retired side, now we're just going to do the same thing with the younger client side, like it wouldn't work.
Yeah, it wouldn't. And even just to that, just so the numbers make a little bit more sense, with the 3 advisors on the wealth builder side and only one support advisor, the newest advisor, like so one of the 3, was a support advisor for the other advisor up until the last 3 to 6 months. So it was more of a 2 to 2, and then she kind of evolved, and now she's starting to work with clients that are coming into the firm and building her own client book, so to speak, within Drucker Wealth. And then we're going to be hiring another support advisor over the next 3 to 6 months. So the numbers, I think, just at this exact moment that we're speaking, are a little bit different, but it's just a snapshot in time, because obviously once you transition somebody in a support role to a lead advisor role, well, then it takes time to find the next person to fill the gap on the support role. And that's the exact, that's a snapshot of where we're at right now.
Okay. But the client, well, so I guess is, with the new advisor into a lead role, is the where do you feel you are relative to capacity for the wealth builder side? I mean, if you're at 3 advisors for close to 300 clients, but someone just came up, like, are you close to capacity? You're like, no, we could go to 400 plus now that we've got this expanded advisor capacity.
Yeah, so I do think we have capacity, but we will be hiring. We will be hiring another advisor in the next 3 to 6 months. We're actually talking about hiring an internal CFP, and to really focus more on the building out of plans, of the upfront financial plan. So like the start of more of a financial planning department, as it were, to, when a client first signs up, to build out the financial plans behind the scenes, run the input meetings, and kind of deliver them to the lead advisor, and then deliver the plans together. So we're in a little bit of a transition period, I would say, right now, just because the one advisor, kind of stepped up in role, and we're going to be hiring another internal CFP, or a new internal CFP, and then a support advisor after that. So I would say we're at capacity now, but we are thinking ahead of understanding how many new clients we've been adding and what that's going to look like.
And is there just an overall difference in profitability between these?
Yeah. So I would say, yes. I mean, just from the raw numbers of it, the retirement and income side, having done this for so much longer and kind of gotten into a rhythm working with clients for 20, 30 plus years in some cases, it is more just, profitable day to day at this point. But quite frankly, like the Wealth Builder division, because of our growth, I would say we're at that point right now of reinvesting into the business, making sure our client experience is always top notch. Like that is the most important thing to us. Marketing is great, but if you're not doing a great job for clients, and you're not delivering on everything you said you were going to, then they're not going to stay with you. They're not going to introduce friends and write Google reviews and do all the things that has helped, kind of grow us exponentially. So I would say right now we're at this point where, the Wealth Builder division, is a full cup, like if you think about it as, a water bottle, but it's only 20% full. And we know we can fill up the rest of the water over the next year or two. And we're at that point right now. So, just from the simple fact, quite frankly, that our Wealth Builder division, because of who they are, right? Average client is 42 years old, making $400,000 to $500,000, and that number keeps growing. They're adding $5,000 to $10,000 a month into their accounts. When bonus time comes, they're adding $200,000, into their investments. They're maxing out their 401ks that we're managing. So we really got to see over the last 4 or 5 years, like it's starting to happen because we have a long enough track record of seeing, average revenue per client, what it might have looked like when they became a client. We're managing 500,000, and now, it's 4 years have gone by, and obviously some market growth, is a part of that, but most of it is just they're adding a lot more to their accounts, and they have a lot more going on and opportunities. So we're seeing, like our average revenue, like each month seemingly is going up just because our clients are adding to their accounts and they're just at that stage of life. And then the second part, we've become really intentional of making sure that each client is paying a minimum financial planning fee. We've graduated, or had to kind of move on clients. Last year, 2024, we graduated over 25 clients that just were below really what made sense to be working with. Like they had the best deal in town, which good for them, but it didn't make sense, for us. And 25, other clients, they started paying a minimum financial planning fee on top of their 1%. And then we've increased that minimum planning fee for 2025. So we realized that, in the beginning when you're just building this, and again, this all happened organically, right? So like in the beginning, I'm working with anybody, what's the expression in BD world? Anyone that can fog a mirror.
Yeah. Yep.
In our case, it was anyone that would do an upfront financial plan. So that alone made it a little bit better than it otherwise would be. But we've really taken the last 12 to 18 months, and that's an ongoing project, we're not there yet, of making sure that every client that we are committed, we're providing all this value to, is at least paying a minimum fee so that we are increasing profitability and that our larger clients are not paying too much more relative to our smaller clients. But as you know, that that's an evolving conversation and it doesn't happen overnight.
So then help us understand more what the fee structure or revenue model is for the business overall, I guess across the two divisions, since it sounds like, again, they're a little bit different in fee structure.
Yeah, so it's really the same fee structure.
Okay.
We've just had to put maybe like a minimum planning fee parameter on the wealth builder side, just because these clients are younger, newer, and because we're actively promoting and doing a lot of content creation and marketing around the wealth builder side. But every new client coming into Drucker Wealth, regardless of division, regardless of advisor, everybody starts by doing a financial life plan, is what we call it. But it's an upfront financial plan for a flat fee. We take 2 to 3 months. We really look at every aspect, comprehensive planning, right? Every advisor talks about it. In our parlance, how we talk about it. We go through every aspect of their financial world. Spending habits, saving habits, how money moves throughout their financial life, right? Like how does money move between their checking, their high yield savings, their investment, their 401k? Do we need to dive a little bit deeper in budgeting? Sometimes we do, sometimes we don't. And even I'll say, somebody making $700,000 a year, they're saving a great amount, but because they're making so much, what we call a dangerous amount of money, they have no idea what they're spending, and not knowing stresses them out, right? Even if they're saving what they should be. So we will spend a lot of time there looking at their estate planning, their insurance, their cash flow, their investments, and starting to model out some of their financial priorities, goals, what they're trying to achieve. So all of that, over the first 2 to 3 months, we build out this plan. We charge half of the upfront fee we charge half the fee up front, half at the end of the plan after we've delivered it. And that's how everybody starts.
And what's that? Yeah. What is that planning fee? Like, how do you set the fee?
Yeah, so it's anywhere from $4,000 to really, I'd say $7,000, $8,000 on the high end, and we tier that based on household income. So our starting fee for an individual is $4,000. For a couple is $5,000. So if 2 people are involved in the plan, $5,000, and that's if you're making under $500,000 of household income. If you're between $500,000 and $750,000, it goes up to $6,000. And if you're $750,000 to $1 million, it's $7,000. And then after that, it's a little bit more negotiated nuance, just understanding what's going on. I think there's no perfect way of setting that, that flat fee. I think, income seems to make sense. The more income, the more clients typically have going on, traditionally a little bit older, even within the wealth builder side. And that seems to work. And we have this on our website. I think that's one of the best things we did when we were revamping our website a few years ago, and I can come back to that. So clients know from day one, whether they're listening to my webinar or they're going to our website, exactly what those flat fees are, and even before they set up their first call with us.
Okay. And so as you're building out this fee structure, I guess it kind of scales with income, but it's not literally a percentage of income. Like we're not pulling out a calculator and doing the math, but in practice, it is kind of a moves with income with some breakpoints functionally.
Yeah, exactly. For this upfront fee. And yeah, I've seen the calc. We want it to be clean, transparent. We want clients to know, like, they look at our website, they know what they can expect, both in terms of the service model, the pricing, and it just so I think for those reasons, we want to keep this upfront fee as straightforward as possible. And then once clients go through this initial financial planning engagement, we like to say they can go in one of 2 directions. They can say, hey, the plan was great, phenomenal, answered my questions, understand what I'm doing, or even validated some of the decisions I'm making, or pointed out some things. Sometimes clients come to us and they already have an advisor and they really want like a second opinion, or they want to know what's missing. And we say, yeah, so at the end of the plan, you can say, great, it all makes sense. I'm going to go take your plan and implement this on my own, or bring it back to my friend who's my advisor, or I'm going to go implement the decisions just internally as a family. And adios, totally fine. We got paid for the work we did over that 2 to 3 month engagement. You got everything you wanted accomplished, and then you go on your way. That's option A. Option B, obviously, is they can say, hey, this all makes sense. Now I'd like your team's help to implement the plan. I'd like you to become our ongoing financial planning and wealth management team. And that's when we would, open the new accounts, transfer what needs to be transferred, set up the monthly savings strategy, do the 401k rollovers if that's that's part of the plan, set up the insurance or the estate planning recommendations to be implemented. And then they'd have semi-annual review meetings with their lead advisor, their team's available whenever they have questions, and it just kind of builds out the ongoing phase of the relationship. And on that side, that's just a assets under management fee. And most clients, most transparently, most clients do choose option B. Like from the start, they're reaching out because they really want that sort of ongoing partnership over the long term. But I think it's really important, and I know there's all different ways of doing this. I think it's really important that clients know, hey, I'm getting this upfront plan. I'm paying a flat fee. I know what I can expect. I can analyze it, validate it. I know at the end of 2 to 3 months, I'm going to have a lot better picture of what this ongoing relationship would look like. And then I can feel more comfortable to make that second decision afterwards, rather than we meet twice and I'm going to hand over my life savings and have you guys manage it, indefinitely. I think this plan is a really good way of kind of gradually bringing them in to our planning process, the way we speak with clients, the way we do things, for them to make that second decision a few months in.
And so is there some, I think you said earlier, there's some asset minimum or minimum fee that they do have to pay to do the ongoing relationship after the initial plan?
Yeah, and this is a moving target, so I'm going to get into the numbers. All of our existing clients last year, anybody on the wealth builder side, anybody that wasn't paying, that didn't have at least 250,000 of assets under management, we reached out and basically said, hey, we're growing, we're doing, here's everything we're doing for you. Just quite frankly, like we need to raise our fees, in order to keep providing this level of service value. We're sure you can understand, why and how. Here's what it looks like if you, want to pay these new fees, which would effectively just be 2,500 flat fee paid quarterly on top of the 1% we're already managing. So if they're, already, 100,000 under management, it'd be 1% of that plus 2,500. And, or, we're happy, if that doesn't make sense, if you're not comfortable, we're happy to, introduce you to another custodian. We can give a few recommendations of, hourly advisors that might make more sense if that's the direction you're looking to go. So we kind of laid that out all throughout 2024, really kind of mostly like at the end of the year. And then at this point, so everybody 2025, all new clients, the minimum the minimum household fee is $5,000 annually.
Okay.
It just, I felt it was tough to do, to go, if a client is 100,000 to say, hey, you were paying us 1,000 a year, you're going to go to 5,000 a year. It just, I didn't think we could do that in such a short period of time. It wasn't right. It didn't make sense. Even if I know the value we're providing is, such that we should be charging a minimum of 5,000. So that's why the numbers are a little bit different, because I kind of grandfathered existing clients into what the lowest point I thought made sense, even if those clients are kind of still an anomaly or an exception, but at least they're an exception in a way that's still, we are generating profit from that client relationship.
So I want to make sure I understand just mechanically, like, how this works when you said it, because I thought I heard you say so if they're under 250, there's a $2,500 a year like minimum fee, platform fee, and they're still paying an AUM fee for their $100,000 or some number below the 250 minimum. So it's like 2,500 and to try to get the total revenue up a little bit higher.
Correct. And a lot of those clients, quite frankly, like we took this one by one. If somebody had $230,000, we kind of said, hey, you're going to pay a flat $2,500 because they're so close.
Right.
Like I'm not trying to have them pay that, and that would kind of go against what I was just saying of not like quadrupling their fees. Most of the people that are paying both, it's really below 100,000. So it's that 1% is really a really small amount, really frankly.
So the idea is once they get to 250,000 of assets, that fee gets waived.
Correct.
Okay. So,
and again, that's just for the existing clients that we were already working with. Okay. Clients that have been coming on the last few months are aware from day one that the minimum annual fees are going to be $5,000.
Yeah. So I guess, can you explain a little bit further, just like how you literally rolled this out, like broke the news?
Yeah. So looking back on it, and this all happened, throughout 2024, I get anxious about a lot of things, don't get me wrong, but this just really wasn't one of them, because I really was, and our team of advisors was just really confident in the value we're providing clients, what we're doing for them, the fact that, most of these clients had been paying, a very small amount for a few years. As we're having multiple meetings a year, we're available whenever they have questions. It is an in-depth relationship. And so we were confident in what we were doing, the value we were providing. And also our clients, even the clients paying a small amount to that point, like their income, all of our clients' incomes are above 200,000. Like these are clients that if they want the ongoing financial planning relationship and they value the work that we're doing, like they can pay for it, right? This isn't a matter of they don't have the funds. It's, do they think the value we're providing and the relationship, and not even the value, because, sometimes I think advisors, we can make it too much about us. Sometimes it's just, the stage of life. Like clients might say, hey, you guys were so helpful in getting me set up the first year or two. I had no idea what I was doing. I didn't know what my 401k, I didn't understand the insurance or the RSUs, but like you guys did all of that. And I'm not married. I don't have kids. I don't have all these other things going on. So thank you so much, but I got it from here. And like, that's not a reflection on our value. In fact, we got them to where they are. It's just, the moment in time of, they didn't feel like they needed the help. So anyway, that's kind of how we went into just like the thought process around it. At terms of how we actually, I wrote out kind of a long email, just kind of laying out, hey, here's where we're at, as a firm. Here's the different things, we're doing for you. Here are the things that we're actually adding to the mix, in terms of what we're able to do for you, and like new service models, new things we're doing. And here's what's going to be implemented 3 months from now. We want to give you enough time to really think this through, ask any questions you might have. And so we sent that email with a link to their individual advisor's calendar and said, hey, once you've gone through this, set up some time. We're happy to discuss it, happy to answer any questions and talk it through. And that's the way we did it. I thought the email would be a good kind of lead in, so they really can like sit with it in their own time, kind of lay it all out together, rather than just like, you're on a Zoom, you're on a phone and just saying, we're increasing your fees, and then they can't hear anything else you said.
Right. Because they're doing the immediate emotional response kick in of like, my fees are raising. And
you can say that, that's us being a wimp as well. Maybe, I really think sometimes people can read, kind of process information in total, and then they can come to us once they've thought it out, kind of ask their best questions rather than their first questions. And that's, exactly how that laid out. And again, this wasn't a huge amount of clients. We're spending a lot of time, so I don't want to make it sound like this is like a bigger thing, but I know this is a challenge for a lot of advisors. And we had that of, hey, these are clients that have been with us for a few years and got us started when the Wealth Builder, I don't know even know if we had the name the Wealth Builder division. It was just, hey, I want to work with young clients because I'm young, so work with us. Which is what it was at the time. But as we're growing, as we're bringing on more clients, we really thought this was necessary to get us to that next point.
And so you said the start of this was basically laying out, here's what we're doing for you now. Here's what we're adding going forward. What were the things? I mean, how did you frame up what we're doing for this fee, things we are looking to add in the future?
Yeah, some of it was just kind of, organizing what we were already doing, but just, when it happens throughout the year, right? Sometimes you're not like looking at a list all at once, semi-annual review meetings, going through their tax return, talking tax strategy throughout the year, talking about their estate planning. And, a lot of our clients, our clients are having new kids like every year, every week seemingly. If anybody wants to know like the most popular names for children these days, they can come to our team because we have that on lock. So, which involves updating their insurance and updating their estate planning and talking about their education funding targets, right? It's like its own value add of, hey, how much are we funding towards your education goals? How does that impact the retirement planning work that we're already doing? How do we think through your emergency reserve? Because again, that's not a static thing for most of our clients. Like every year or two, they're doing a renovation, they're buying a new home, and that's an entire conversation by itself, on top of, obviously the investment management, the trading, the cashiering, setting up their high yield savings account, their cash accounts, which most of our clients have at Altruist. So it's laying out, I'm not saying anything that, I'm sure most great advisors aren't doing, but just kind of laying that out all in one organized fashion. So they really understand, what the relationship is all about year to year.
And so you're like bullet pointing this out for them, like boom, 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 boom. We do all these things.
Yep.
And then do you say you also tried to frame what you were adding? This was like new services rollout as well?
Yeah, and some of that was, not like, hey, this is happening on day one, but, where we just hired an internal estate planning specialist to help our clients with their estate planning documents that are created through wealth.com. Obviously, we're not, estate attorneys, but somebody really guiding clients through that entire process. Ultimately, we want to build a tax division. We've partnered with Sora, for loan and, finding new, refinancing opportunities. So just a little. It's less about, hey, we're doing these new things and this is why you should work with us, and more, hey, here's what we're, why we're growing, what we're trying to become, and what we imagine the firm to look like over the next 3 to 5 years. Just because, I think, if clients say, hey, I want to hitch my wagon to you guys, not just because of what you guys are doing today, but kind of what can I imagine, these clients are 40, like their income, their growth trajectory is going to look a lot different 5 years as it does today. And they want their advisor to be the same thing. We're growing, we're evolving, and I want clients to know that as they're thinking about their future and ours.
And so now it's like zooming back out for a moment. You said like you started down this road like 4 or 5 years ago. It's now closing in on 300 clients. It's $1 million or $2 million of revenue in this Will Filters division. So where did like 300 clients come from in 5 years or so?
Yeah. So without going too much into my background, I will just give a little bit of like how I joined Drucker Wealth, because that kind of, that story kind of brings us to the marketing. So I grew up, I don't think I've said this yet. I grew up, in the business, so to speak. My dad's been a financial advisor, running his own business, my whole life. I mean, his whole life since he was 21. And personally, my dad's been my hero, role model, best friend, kind of all wrapped in one my whole life. So as a kid, naturally, I wanted to do, quote, what my dad did, just for no other reason than he was my dad. But I really liked that, he worked for himself. He had, had his name on business cards. He made things happen. I loved coming in on holidays and like mailing out his client appreciation letters and, like all that stuff. When you're like a one-man shop and running a business, it really becomes like the family, the family business. Everybody, is involved in hearing stories and all that. So that was kind of, my lead in. I never wanted to do anything else. And, I joined Drucker Wealth at the end of 2016, beginning of 2017. Actually, after serving as a paratrooper in the Israel Defense Forces for a few years. That was kind of my after college before joining Drucker Wealth. Hardest, most meaningful experience of my life. Anyway, so I came in, after that. At the time, and again, I think this is just kind of helpful now that we've already kind of shared what the firm looks like now. We had 5 full-time people at that point when I came in at Drucker Wealth. And really, like, my dad was the sole rainmaker, for lack of a better word, on the team. He did the prospecting, closed all new business. Any new idea, any new initiative came from him. And the team around him, including Kitty, the advisor, the team now, like, everybody was there to kind of manage, support the clients that he brought on, and kind of moved as he, had new things to bring to the team. So I came in at that point, and really my first 6 months, I sat in on my dad's meetings, right, taking notes, just learning whatever I could, asking questions, learning the business from the ground up. I did a lot of the admin or assistant prep work, right, just to like, pay my dues and like learn, all right, what do we do, prepping for meetings, all of that. But at the same time, day one, I knew my job was going out and getting clients. Like that was, I couldn't be in this business if I wasn't developing my own client relationships, closing business. Like if I couldn't do that, quite frankly, like none of the other stuff like mattered. And again, that's a little bit of, when you're in the BD environment, but it was more, it came from myself. Like I knew I wanted to produce business. I need to generate business like my dad. And I just knew I'd never be comfortable being the stereotypical next generation that like comes into a great business and is just tasked with keeping the lights on.
Right.
Gliding along, I'm first to admit I have a little bit of an ego chip on my shoulder. So I knew I wanted to build my own client relationships, prove I can do it. So that was always like day one. It was, all right, how do I find my clients? And I tell all of that because at the beginning, it was really twofold. It was, orphan clients at the BD, right? Clients that had my dad's name on their statements, but they weren't really our clients. We just got handed them when an advisor left or, what have you. So calling those clients, and then, what the insurance companies call their, the natural market, right? And just kind of filing that out. So that was really like my first 2 years was just cold calling orphan clients, reaching out to friends and friends of friends, doing a small Roth IRA here, and small insurance policy there. Just like, but those were, looking back on it, and all the marketing that came after, like I would spend my Saturday afternoons with like a stack of 200, quote, orphan. I know there's probably a better term for that, but this is what they were, what they were called.
That's how I grew up knowing them, orphan clients.
Yeah. So I would call, sit at Saturday afternoon and what I term the most depressing, office space in America. And, I had a rule, like I had to get at least 50 people on the phone. Didn't matter what happened, but I had to get 50 people on the phone before I could meet my friends, wherever, bar, or whatever they were doing. I was in my mid-20s. And, that was, not the most, fun entry point, and, a lot of rejection, a lot of like, oh, you're my advisor. Like they were like warmer than, I guess, if our names weren't on the statements, but like not that much warmer. We were just to them, we were the insurance agent or whatever that was calling them from a policy they set up 15 years ago, and they don't know anything about who we are. So that was really that started kind of everything. And I did that for a few years, and another kind of, I don't say point of failure, but point of just, I started doing these like wine and finance classes with another advisor at the broker dealer that like brought me in to speak at these events at companies where a sommelier would talk about wine, I would speak about finance, and we'd go back and forth for an hour or two. And really good experience looking back. Like I spoke at small companies, at large companies. I spoke when people were showing up late, were disinterested. Like just getting comfortable speaking in front of a group was fantastic. And like you're talking to 3 people that are 100% there because they're getting wine.
Yep.
And do not care about
some people out.
Do not care what I have to say. And so again, I think I got 1 client from that entire endeavor, but it was a good learning experience, and to teach you how to speak in front of a room and learn, speak on your feet and learn and follow up. Right, that was the big part. Leaving your card and then calling and following up and sending an email and all of that, but didn't actually net that many clients. And so that, and I hope that wasn't too long, but that was kind of the first 2017 through 2019. A few things hit just because the law of numbers. If you're reaching out to enough people, you're going to get some big clients, and I was able to kind of set that up for my dad, and that kind of kept the lights on for me as well. And then 2019, I kind of I looked around and said, all right, this cold calling is not how I'm going to spend the next 30 years building a book of business. It's in my opinion, like soul sucking. I didn't enjoy that. The idea of networking, like going to networking events, was the last thing. It's just not my personality. The last thing I imagined doing. And I always loved to write. Like that was always, kind of my thing in high school and college. I was an international relations major. I was on the student newspaper. I had a popular blog at the Times of Israel, after college. So I always loved to write. Like I genuinely enjoyed it. I was pretty decent at it. So I started writing blogs for Henry's, right? High earners, not rich yet. And then I started, I had the idea of turning the blog or all the blogs into a book. And that was really the turning point for all of this. I spent 2019, sitting in coffee shops on Saturday afternoons writing this book, and it came out in February of 2020. It was launched. So How to Avoid Henry Syndrome was the name of the book. It came out right before the pandemic, and it did pretty well, like not in terms of like books sold, but just, kind of, I was interviewed by Business Insider. It kind of made waves a little bit, I think mostly just because of that Henry acronym that was starting to get really popular around that time. And so the book, started to do well. And then I kept writing, and that started to build a little bit of an audience. And then we partnered that with a webinar series where I started doing these free webinars twice a month aimed at high-income earning mid-career professionals, people in their 30s and 40s. And we used the book cover as the ad, as the advertisement on Facebook and Instagram. And so we started doing these webinars, and then everybody from the web, that signed up for the webinars would get on our newsletter list. And I started building out this, at this point, it's like 90 separate email newsletter where once somebody signs up for the webinar, downloads the first chapter of my book, and those two things could be independent, they start getting these newsletters twice a week, every Tuesday and Friday. And all of that content marketing started slowly at first, for sure, but slowly started to compound on each other. And at the bottom of every newsletter, at the end of the webinar, I had a offer to set up a 15, 20-minute Right Fit call. And that started going, and I still do these webinars twice a month. We've done it a little bit more evergreen at this point, just as it's gotten bigger. But that, all of the turn in the business and the turn of the wealth and the start of the Wealth Builder division is when I moved from just kind of following what, seemed like the natural BD of, orphans and my natural network, and started writing and doing content writing and letting that kind of evolve on its own over time.
So it sounds like the starting point for this journey was an initial blog targeting Henry's.
Yeah, and blog is probably even too. It was more like I would write like an article for clients. So it was really like internal facing, and then we post on Facebook, and so that was really it. Yeah, like it wasn't a public facing thing, and the blog didn't get any traction by itself. For sure, it was really when I started to write the book that just the fact having a book, is, like the books, I was young, it kind of stood out. So the book is really what got everything going. But the book only came about because I was doing a lot of writing already for these client newsletters and blogs. And then the start of the book were all these blogs that I put together and then started elongating everything I was writing and making it all flow into a book format.
So I'm fascinated by this. So what were you writing at the blog stage, at the initial blog stage?
Yeah, so it was nothing life-changing, quite frankly. Like, I'm talking, a lot of Nick Murray, like, hey, investing for the long term, and how do we think about stocks versus bonds? How do we think about a pre-tax 401k versus a Roth 401k? How does, term insurance for a young person fit into the mix? When we're thinking about buying property versus renting property, what are the kind of benchmarks? What do you want to think about? So just, again, none of this was super different, super crazy. I'd say one of the ideas that I think got popular early on, like with the people I was trying to reach, was this idea of making a dangerous amount of money. Because, again, if a lot of my clients, and at that point they earned a little bit less, but what I call a dangerous amount of money is if you're making, mid six figures, 300, 400, you make enough day to day to be totally comfortable, right? Like you don't have to worry about where you're going out for dinner, trips, how much is it? You're maxing out your 401k. You're doing all these things, but you're not making $5 million, $10 million that you don't have to think about a long-term plan, right? Where you're just like, oh, I set it and forget it. I'm going to be totally fine. So this idea of a dangerous amount of money is, all right, I'm great and I'm comfortable day to day, but I still need to make a plan for the long term. And that dichotomy can feel a little unnerving, right, for families in that situation, where it's like, all right, I don't know where things are going, but I don't have any money issues. So that idea, again, that's just like one example, but it was something that I tended to write a lot about and use some client stories to drive the point home. I tend to write a little bit long, and I'm working on that, but I do think that also gave a little bit more credence to everything, because it wasn't like I wasn't trying to write a paragraph of like boilerplate. I really was writing, 1,500, 2,000 page blogs. And, I figured people that were interested enough to read that long would then reach out to us. And because if they cared enough to read the whole blog, they probably care enough to find out more and see how it all comes together.
Yeah, I found a very similar phenomenon as we started putting out our long form content on the kitsis.com end as well. There's all this discussion of people have short attention spans and they don't want to read anything long. And I'm like, that's true for like 98% of people, but 2% of them do read long things. And the people who tend to read long things are people who have a lot of money at stake and significant problems that they're willing to spend time on, otherwise known as good prospects.
Exactly. Right. You want to, what do they say? Like on your website, you want to repel 99% of people that show up there, but you want the 1% to be exactly who you're meant to serve. And and that's exactly how we think about it. It's also how we think about the upfront financial planning fees, quite frankly. Right? If you're engaged enough and willing enough to pay an upfront fee, and you see the value in professional advice, right, and expertise, and relying on an objective outside party, well, that's somebody we want in our universe, right? That's somebody that's probably going to be a good client if they see the fee and they're not, oh my God, why would I pay a fee before you even manage my money? Well, somebody that's their first instinct is probably not going to be a good long-term client anyway, because they just, for whatever reason, don't value financial advice and expertise. Same thing in terms of somebody that's committed to reading, a long blog or listening to a 2-hour podcast or what have you.
And so you were writing these blog posts. How often did you say at the blog stage?
Yeah, I don't remember at the exact start, but we publish or send out at this point, and for the last few years at least, we send it out twice a week. I would say I probably write a new one at least every week. I really the last year with the firm transition and just everything new we're doing, a little bit less, quite frankly. But I got in a rhythm where I was writing at least a blog or two a week, I would say.
Okay. So
usually like early morning, sitting with my coffee, having an idea that I like keep on my notes on my phone, and then just, taking that, or that I come up with, I'll go for a run every morning, think about an idea, put it down in a quick note, and then write it out the next morning at 6 a.m.
And so I'm going to presume then you're a pretty fast writer typist. Like how long did it take you to crank one of these things out?
Yeah, 30 minutes for it. And I would say with all of this, perfect is the enemy of good. And I'm definitely, a type A perfectionist. And honestly, it's why I haven't done videos yet, because I know I would obsess about, I wanted that word to come out a little bit better. So let me redo this 10-minute video. That was great, but that one word could have been better. I've gotten over that with writing, because I can spend as much time and make it perfect, and then I'm off. So videos are our next thing. And I'll admit that's just like a personal challenge I need to get better at, of being okay if I mostly get the point across and it's not 100% of what I want, it's good enough. But I'm able to do that writing and kind of get it out there and let people read it without going through it 15 times.
And so how many of these blog posts did you write before you said, I think I have a book here?
Not that many. I think the book, and my dad wrote a book earlier in his career, not like at my age, more like, when he was, I'd say in his mid 40s. And so like it was a part of his, I think it was his idea probably of like, hey, you're a good writer. You enjoy doing this. You should write a book at some point. And I was like, all right, well, I can write a book now because I'm not getting as many clients as I want. And I don't have that many clients right now. So like now seems like a good
time now.
Yeah. Now seems like a good time to change what I'm doing and how I'm doing it. So that's, the book didn't come out of nowhere. He had written a book and it was successful on his end as well. And so that's kind of how it started. And that's why I think it was a little bit earlier than then maybe it would have, like, I didn't have 100 blogs. I might have had like 8. And then I was like, all right, now let's go build this book around the blog.
And so, so how did you actually go about like getting, the book done?
Yeah, so I did all the writing myself. Again, I enjoy it. It's kind of it was a fun challenge to get to put it all together. I had a long Google Doc that I just kept updating, and then we had a publisher. And I'm actually finishing my second book now, and we're using her again, Sarah Stratton at Redwood. And she helped me put the book together, from like editing, publishing, handling, getting it on Amazon and Barnes and Noble, and the cover design, and like all the things that I would have no idea about, like getting it licensed with the Library of Congress, I think it was. I could have made up what that's called, but like all the things that I had no interest in, and like handled our pricing, which I really had no interest in because I knew I'm not becoming a famous author. This was a way of getting financial planning clients. I didn't really care how much we made, and I actually dedicated the proceeds of the first book to Flags of Honor, veterans organization, 100% of the proceeds, which isn't a big deal. To be clear, I'm not patting myself on the back. The book did not make that much money, and I donate to the organization anyway, but it just seemed like a good way of getting more publicity out there. So she handled the pricing mechanics and really all the things outside that I had no knowledge of, or quite frankly, interest in, of like publishing a book in the first place.
And so how did it work? Like you get like a royalty from the book they published, you get the revenue, but you paid them a flat fee to make this happen. Like how do you actually engage
the publisher?
With, publisher this way? Yeah.
It was a flat fee for the work they were doing to get the book launched.
Okay. And just curious, you recall like what?
I knew you were going to. I honestly don't.
Just even the neighborhood, is this like thousands of dollars? Is this tens of thousands of dollars?
No, not thousands of dollars. I want to say under. Okay. I want under 10.
Okay. And so you publish the book. Redwood Publishing makes it happen and appear on the internet and Amazon and all the places that books appear when you hand them the transcript. So then remind me again. So what came next? Is this the point that it starts going to webinars?
Yeah. So pretty soon after the book launched, I started doing these webinars. And again, it was COVID. Everybody was in their homes. I had done public speaking. I like speaking in public. I had done these workshops, seminars, even if they weren't that successful. And so we figured the webinars were good, and I have to credit my partner, Bridget, who's our head of people and business development. Like the two of us we threw a lot of stuff against the wall and said, hey, we want to start using Gideon's writing ability, the content creation, the fact that our clients are at large, a lot of clients at large tech companies, and they speak to each other, right? And they're in company Slack groups. And we just thought, hey, if we can make inroads in this sort of group, we can stay here. This is something that could have legs, that could build out over time. So we started doing the webinars, advertising on Facebook, and Instagram, and then we would send it to our clients. We started sending it to clients that, people that were already on the newsletter series, and all of these things kind of, it was the reason I love content marketing and the way we've built this out is every dollar you spend compounds on itself, right? So if I'm writing a blog and I send it as a newsletter to prospective clients that get on our list because they downloaded the first chapter of my book, and then they see my webinar, and then they're right on the list. Well, that blog, they might, they're going to see it a few times, and they're going to, maybe be able to, if it's something that's really specific to their life, they're going to pass it to a friend, right? If I'm writing about buying a home and their best friend or their sister is buying a house, well, they're probably going to send it and say, hey, this might be interesting to you. So I like the idea that any money you're spending on, like advertising and any just like time I'm spending writing or doing a webinar, it's all going to come back, like, as opposed to like, I don't know, not to, but like, a custodian referral program fee. And again, I'm not just, it was the first thing that came to mind, or, anything where it's like you're spending $1 to hopefully, or like a lead generation service. It's like you're spending the money, but then if you don't get the client that, or the prospect that came out of the thing, then you're kind of, that money is down the drain, as opposed to, like we have a new client from last week that she joined our mailing list in 2021. She's been getting emails from us, for 4+ years before it made sense. It was the right time of her life. I think she was single when she reached out. Now she's married with 2 kids. Like, things have changed, and now she wants the help, and we've been top of mind for her for years. And so I like that idea that it's, everything is building and compounding on itself over time.
So what were the webinars actually about? Like, what was the focus of the webinar?
Yeah, so a few different things. They're all the same, and I make like small adjustments every time. A lot of like tax planning, like just helping people understand, hey, like what is the pre-tax bucket of money? What is the after-tax? The tax advantage or Roth. A little bit about just our financial planning process. Like, I explained our financial life plan process, what it covered, how clients thought about it. So I really tried to strike a balance between just pure information, things that they can think about and help them understand that maybe they didn't know, with, hey, here's what it looks like to work with Drucker Wealth. And I always thought, like, trying to hide that you're trying to get clients by doing this free webinar is a little ridiculous, right? Like, everybody knows, like, anybody that's hosting content is like, hey, there's, I want to provide value. I want to give an education, but I'm also trying to get, I want to, if we're a good fit, work together. So I was always like very upfront of, hey, we think this is our financial planning process. Maybe you're going to want to work with us. Maybe you're not. Maybe you're going to want to do everything I'm talking about on your own. But if you're interested in financial planning, you should be thinking about all of these things. I'm going to present it the way we work with clients, but you can kind of think about this in your own world as well. And I just think being upfront of, hey, here's what we're trying to get out of this, and here's what what this all looks like, tended to resonate, because I wasn't trying to hide the fact of, like, at the end of this, you can do a financial plan. Well, like, yes, I assumed at some point you're going to want to do, you're going to do something. And I put that at the start and at the end, and made sure that I talked about real, like, just tax strategy and ideas that had nothing to do with Drucker Wealth. So it was a nice balance.
And so, like, what do you call the webinar?
How to designing your financial life plan. And we trademarked this financial life plan of, kind of our initial planning engagement. And I do think the webinars, the fact that all of this leads to a flat fee upfront financial planning engagement, I think also, like, that was another turning point around that time, because you're not taking people through a 7-meeting sales cycle of, like, hey, at the end of all of this, you're going to want us to manage your assets, or, if we don't really do that much insurance anymore, but, or, you're going to want this insurance. It was like, no, you're going to have an initial call. Then we have a discovery meeting where we're going to talk everything out. From day one, you're going to know what the upfront fee is. And then at the end of that discovery meeting, you're going to know if you want to work with us or not. So having this content lead generation, like, flow into a very binary, either you want a financial plan and you want us to do a deep dive in everything you have going on, or you don't, I think complemented the marketing efforts really well.
And ultimately, is the thing you said, you do 2 webinars a month. So it's the same designing your financial life plan webinar over and over again. I mean, you're iterating on it to improve it. It's not like there's a multi-webinar series and people come to multiple webinars. Like, you've got the webinar and you do it on an ongoing basis.
Mostly, yes. We've been experimenting more. So 2024 was just, the firm transition to the RIA and like new client, like, it was just a whirlwind. So there's something to be said for having the same show and just showing up and delivering. We're experimenting more now and we've been doing this off and on, but I think we've realized it really works. It's that thing of, like, you do something once it works, so you never do it again. That fantastic thing of smaller webinars where, like, like I did one a few weeks ago for parents. So financial planning for parents, where I spoke a little bit more about estate planning and term insurance, because I've yet to find a family that's, making $600,000 that has enough term insurance to replace their income and their lifestyle if, God forbid, something were to happen. And that one really resonated, actually. Or like we did one, if a lot of our clients have RSUs because they work at large tech companies. So we did one, planning for your RSUs and your financial plan. So for those, we get a lot lower turnout, and a lot of times we're not even advertising those because it's a lot harder, right, to make sure you're advertising to the exact right person. We're just sending that to our newsletter series, which we have 7,000 plus people. So it's a lower turnout, but it's a lot more targeted. Because anybody that has, I have RSUs, I've never really thought about them beyond just I sell those to pay for the kids' camp. Maybe I should be doing something different. So the same show in general, but then we're working on specific, more targeted things as well.
And how many people come to a typical webinar when you're doing them with this frequency?
I would say 130 to 200 people sign up. Maybe like 150, I should say. That's more fair. It's like the average. I would say like 25% show up. It really flows. Like there can be 20 people, there can be 45. I truthfully, it's one of those things. My dad loves, he's not doing any of this, but he just loves that. Like I'm building this this marketing funnel, right? Because like, especially back in the day, like the number one problem an advisor had was how many, where's your next piece of business coming from? Who's your next client? And that just, at this point, for our wealth builder division, that's not, I can name other things where, like, hey, what's the big focus? But it's not that. So he loves seeing, hey, how many people are signing up for your webinar? How many people were on? And like personally, I just don't care. Not because I don't care. Obviously, I'm spending my night doing it. I care, but because I know it's the law of numbers. And quite frankly, like, so 20 people show up, 100 people don't. Cool. All 220 are still showing up on our newsletter series, and they're going to get all the content, and who knows what's going to come of it. So I try to take a long-term view of all of that, just because I know it's all going to come back in the end, if we're doing a good enough job on the content side.
And is there a typical ratio of how many of the attendees actually will schedule a follow-up right fit meeting, and how many of those eventually become a client? Like, do you have a sense of what how that numbers funnel flows for you?
Yeah, I would say from each webinar that we do, somewhere between 10 and 15 scheduled calls.
Okay.
And that includes a few people that schedule a call like before the webinar. Like they just see the advertisement, they go to our website. We radically changed our website 4 or 5 years ago at the same time, that I think has helped with all of this as well. So I would say 10 to 15 calls so a lot of them come on the webinar itself. Like I can see them scheduling as I'm speaking, but some just come in the course of the week that the webinar is being hosted.
And then how many of those might become a client in practice?
So so in the last 3 to 4 years, last year we had 50 new clients come from webinars. The year before it was 75, and it was 85 the year before. But I would say, if we want to talk about 75 new clients a year, I would say 2/3 of them are coming from, these webinars or webinar adjacent, set, book, Google, all of that.
I'm stuck. It still feels like a good old fashioned version of as I learned, like the 10-3-1 rule in
100%. It's exactly
any kind of marketing. Like you get 25 or 30 who show up. A third of those turn into calls, which is about 10. A third of those turn into clients. So you get like 3 per, and you're doing 20 plus of them a year, and sure enough, that's like 50 to 75 new clients, which is exactly where your numbers.
Yeah, I mean,
numbers have been
almost spot on. I had in 2023 a little over 300 right fit calls held, meaning like they actually showed up for the call. So 300 right fit calls, and from there we did about 75 new plans that year.
And then the attendance from the webinar itself is a combination of, you send it out to the mailing list that you're building, and you're doing Facebook ads and Instagram ads just to encourage people to come to the webinar.
Yep, and it's usually a cover of my book, although with the team we've experimented with different things. And so they sign up, and then when they sign up, they get the first chapter of my book automatically, and then they get on our newsletter series until the webinar is live, which typically they might get one email before the webinar, and then they'll get reminders 24 hours ahead of time, 1 hour ahead of time, 15 minutes before.
And what do you use to run the webinar platform?
We work with 8-Digit Media. We found them 4 or 5 years ago. It's been it's been great, and we've been working with them ever since. And we haven't changed too much with all of with all these marketing, because it's been working. And like you said, it's the 10-3, it doesn't go away.
And so that's what's driving at the end of the day, just all this growth to add up to 300 Wealth Builders clients in the past 5-ish years.
Yeah, that and introductions, referrals.
Sure.
It's been a really, and I know every advisor had. It's been really cool to see how many more introductions we get now than we got 3-4 years ago, and part of that is we were around longer. But I just think as we're really getting better at the client experience and the way we work with clients, providing value, like we've just seen even in the last since the transition, the last 3-6 months, just a lot more introductions. Like last year we had 50 right fit calls from introductions, and I think 3 years before that it was a quarter of that. So that's there obviously, and that's happening more and more. We don't have a good system for that. I don't ask for them. We don't really even bring it up as often as we should. It's one of those things we've talked about every year for 5 years, and it's just I keep saying, hey, if we provide value, if clients appreciate what we're doing, if they know we're growing, which I do talk about, we're growing, then I'm never going to make it uncomfortable, and they'll introduce when they have a friend, a colleague, somebody that it makes sense that they want to introduce us to.
So as you reflect on this journey, what's surprised you the most about building the advisory business?
Yeah, so I think the thing that surprised me the most is how much I enjoy the business side of all of this. When you're getting started, and even before I got started, it was always about, all right, well, I need to learn how to get find new clients and become a CFP, right? I wanted to become a CFP ASAP, just actually have the knowledge, learn what we actually do as financial planners. So it was always those two ideas, and I think I surprised myself with how much I enjoyed everything else, like integrating new custodians and tech platforms and tech partners and bringing it all together and figuring out new service models and client deliverables and value adds that we want to provide, and thinking about how we want to bring new advisors on and how we want to grow the advisors and when it's the right time. All of that side of things, I guess I was pleasantly surprised that I really took to that, and I can nerd out with the best of them, of everything that that's part of why this podcast has been so impactful, because it opened my eyes of oh wow, you have to think about all the stuff my dad was already doing, but within the broker-dealer world. I love thinking about all these other things. And actually, the more you think about it and kind of visualize where you want to get, it actually allows you to get a little, get there sooner and kind of force the needle, force the pressure, the needle. I think the other side, and part that I think I still need to get a lot better at, is just as you get bigger, how much of my role as CEO or just kind of a leader is managing the team, how important the team is, your next hire, the way you train people, and just kind of the general morale, right? How you run your organization. And that sounds kind of obvious, even as it's surprising me that how the team is doing is important. But when you start out so laser focused on the client side and the business development side, you realize no, the degree of Drucker Wealth success is not about our next 20 clients. It's about our next hire. And it's the way everybody on the team feels like they're included and they're growing. And, I think that's something, I'll get better at with age, but it's something I really think about is how do I get better at inspiring the team, right? Making sure everybody's fully invested. My dad is incredible at this. He's that energy. He's still on the day-to-day, making sure everything gets done and growing and all that. He's the energy, inspirational. And I need to get better at that. And, that's something I'm working on, but I think it surprised me how much the team management part matters and how important it is as you get to that kind of next stage of growth.
So what was the low point on this journey for you?
I guess, I have two. The first one, which I don't really know that I can call it a low point, because at the time I wasn't, is when I was calling the orphan clients and, reaching out to friends, and everything was so new that, I was excited to be there, and I was in my mid-20s. So I wasn't, how am I going to, feed a family, or where am I going to be when I'm 40? It was just taking it day by day. And it was a grind, and it was a lot, and, a lot of rejection and all that. But so that's a low point, I guess, looking back. But at the time, it was just, all right, here's where I find myself. And then I think, the transition time and kind of right before the transition, where there are all these exciting things I want to do and new services and new partners. And we're at the BD and there was just so much going on all at once. Right. Sometimes I'm trying to solve 100 different things, and you really got to focus on 3. And I needed to learn that. But just, again, these are good problems to have because a lot of it stemmed from growth. But just a little bit of that overwhelming feeling of, hey, I want to do a million things, but I got to prioritize. The transition has to come first, because just nothing else matters if you're not successfully transitioning and getting your clients up to speed and comfortable at the new RIA that we launched. But that kind of, 3 months before, 3 months after was just a whirlwind of craziness, quite frankly.
So what else do you know now as the business is built and scaled as it has that you wish you could go back and tell tell the you like 5 or 6 years ago as you were starting to build your client base and build the firm?
The one thing is how important hiring is, hiring the right person. And sometimes, you hire from a need standpoint, like, hey, we need somebody in this seat. So this person seems great and let's get it going. And that, is a mistake. But even, I think nobody's a perfect hirer. I think that's kind of impossible. Being really disciplined of like, hey, if somebody's not working out, you got to cut bait. I think there have been a few times where I wanted to be nice. I wanted to give the benefit of the doubt. I wanted to get there. And I realized that I was kind of doing a disservice to the rest of my team by keeping somebody on board that wasn't really a fit and was making other people's lives harder. So I would cut bait a little bit sooner with people that really nice people. And that's part of why it took longer, but that just didn't make sense for Drucker Wealth. Knowing that, that I needed to take my lumps there, but maybe taking one lump there instead of, it happened a few times.
So any other advice you would give newer advisors coming into family practices in particular, having lived that part of the journey as well?
Yeah, I mean, I think for every new advisor, young advisor, becoming a student of the business that was the number one thing my dad said when I was starting out. Especially these days, the information is out there on every aspect of the business, right? Almost for free. It's really not expensive to learn everything from Kitsis.com and from Nick Murray and from, tax, business planning, investments, everything. So I would say, become a student of the business. And I'd say there's, a lot of different ways of being successful in this business. Learn from advisors, and especially if you're in a family business, learn from advisors not in your bubble, outside of the family. I think the best thing I did and the best thing my dad said was, hey, learn from, don't just listen to me. Just don't do what I did. Go out and learn from whoever you want to learn from and pick their brain and learn how they do things. So even down to if you're at a insurance BD or you're at a BD, learn, listen to advisor stories that have their own RIA and charge subscription fees and how they charge subscription fees. And if you're at an RIA or a fee only, I don't know, learn a little bit about insurance and maybe how people got their start in the BD world. I just think there's so much out there. There's no one way of doing things, and it doesn't, learn all of it because you don't know where your career is going to go, that trajectory. And the last part, and this is all tied to that, is, and maybe this is my own, just, being on LinkedIn a little bit, is when you're just starting out, don't listen as much. I think so many advisors, post about, hey, I charge fees this way. And, this is the only way to charge fees. And I charge less. There's a lot of, hey, I'm better because of the way I charge fees. And I think at the start, learn the information, work with clients, find people that you can provide value to, that you can serve, and that'll all take care of itself. Don't get involved in that advisor to advisor conversation that nobody but advisors is actually listening to. Go out and do the work, figure out what works with you, what you're comfortable with. You'll get at the answer that makes sense for you. And that is a little bit off the beaten path of advice, but that's just something I see a lot. And I would just say, get out there and figure it out, and don't get distracted by, a lot of the conversations we as an industry might have, internally.
So as we wrap up, this is a podcast about success. And just one of the themes that always comes up is the word success means very different things to different people. And so you're in this wonderful place of success with the business, 6 million plus of revenue and $1 billion plus of assets, and this fast growing wealth builders division. It's the business is in such a wonderful place now. How do you define success for yourself at this point?
Yeah. So a few ways. I think, as, I already mentioned, becoming more of a leader, for the team, and that's just, I really do want to get better at that, and not that so there's a problem, but I want to keep kind of growing as a person, as a leader in that way, and I really, I want to keep building Drucker Wealth. I think it's fun and exciting to see how big we can get this thing, how many people we can work with, how many advisors and team members we can grow. I'd also personally like to continue evolving to be able to get out of the day-to-day seat a little bit more. I'd really like, my goal as, over the next 5-10 years is if I can be on more podcasts, kind of get the Drucker Wealth story out there, and really have the rest of the team step up more on a day-to-day level. That's really part of something I want to achieve. Part of that is just, I like doing these things. I think I can make more of an impact and kind of grow the firm, talking to a lot of people at once, and, having individual advisors kind of growing and servicing, working with clients. And I have other passions. I'm involved in defending, supporting the Jewish people, Israel advocacy work, has nothing to do with this, but like that's a passion that feeds my soul that I know is important. So I want to keep building Drucker Wealth. I want to keep, kind of growing the next generation of advisors at Drucker Wealth in a way that I can keep doing this and enjoy it and have time for some of these other things part of my life and kind of bring those two things together as kind of part of my ultimate story. And then obviously as I have a family, which I don't, as I grow and have a family and, time for that, which I have not had, that would have been tough over the last few years. And kudos to all advisors that are building and doing everything they're doing, with spouse and kids. But all of that is kind of, what I'm excited about over the next 5-10 years.
Very cool. Very cool. Well, thank you so much, Gideon, for joining us on the Financial Advisor Success Podcast.
Absolutely. Thanks again. Thanks so much for having me.
Thank you.
Want even more ideas, tools, and resources on how to break through to the next level of success as a financial advisor? Check out the leading financial planning industry blog, Nerd's Eye View, at www.kitsis.com, where Michael covers the latest practice management trends and financial planning strategies. And by joining the members section, you can earn IMCA and CFP continuing education credits, along with exclusive member content. Get it all now at www.kitsis.com.